For years, we have discussed the inevitability of a price decoupling, but what happened last night in the Shanghai markets was not a theory. It was a structural explosion. As the sun rose in China on February 24th, 2026, the Shanghai Futures Exchange reopened to a world that had fundamentally changed. Shanghai silver futures didn't just open higher, they gapped up to $99. Within minutes, the price pushed all the way to $102 per ounce. To understand the magnitude of this, you have to look at where the West was sitting at the exact same moment. Western spot silver was stalled at $88.50. This represents a physical demand signal that is screaming. The bids running among Shenzhen recyclers were not noise. They were a roadmap. The physical market was telling you exactly where value was priced before the exchange even turned on its servers. While the Shanghai session eventually settled at an average of $96, the final physical lot of the day reportedly cleared at that $102 mark. Whether you look at the average or that final transaction, one fact is undeniable. There is now a $10 premium between the East and the West. $10. In a market where a 20-cent spread used to be considered wide, a $10 gap is a sign of a total system failure. But here is the open loop that should keep every paper trader awake tonight. While Shanghai was exploding to $102, Western volume was almost non-existent. It was a stalled market. Why would the world's most liquid exchange go quiet while the East is bidding silver into the triple digits? Is the West refusing to follow the price, or is it simply that there is no metal left to sell at the official price? The answer lies in a specific resistance zone we have been tracking between $87.20 and $89. Price has now rejected that zone 3 times. We are sitting at $86.40, trapped below the ceiling. What happens when the paper ceiling in New York meets the physical floor in Shanghai? We are about to see if the COMEX is still a price discovery mechanism or just a digital tombstone for a dead system. To understand the coming chaos, we have to look at the options fear gauge, which just hit a level not seen since the historic spike in January. The options market is currently screaming a warning that the price action hasn't fully realized. The COMEX implied volatility index for silver options has surged to 134. To put that in perspective, when we last analyzed this, it had just broken 100. We are now beyond the highs seen on January 30th when silver spiked to $120. This is not a normal reading. This is the options market pricing in the possibility of violent, potentially disorderly moves. When the price is being suppressed but the volatility index is screaming, those two things cannot coexist indefinitely. Something has to break. Either the volatility collapses, or the price explodes to catch up with the risk. But the stress isn't just in the options, it's in the behavior of the traders themselves. Today, the Shanghai Futures Exchange took the extraordinary step of suspending another group of accounts for breaching trading rules. This brings the total number of accounts suspended in February alone to 23. We watched heavy manipulation attempts at the Shanghai Open today, documented, flagged, and visible in the order flow. The exchange itself confirmed the manipulation was real enough to warrant immediate action. Why are these 23 entities so desperate to manipulate the price at the Shanghai Open? If the market is fair, why risk a total ban from the world's most important physical exchange? The answer is hidden in the March settlement numbers. As of Monday, there are 37,651 contracts outstanding. That represents 188 million ounces of paper silver heading toward settlement in just 3 trading days. The COMEX registered silver, the only metal actually available for delivery, sits at only 88 million ounces. We have 2 ounces of paper for every 1 ounce of physical metal. The clock is ticking toward February 27th, which is first notice day. From that point on, shorts can be forced to deliver metal they do not have. But there is an even more ominous signal emerging from the carry-adjusted basis. We are approaching a phenomenon called backwardation. What does it mean when the price of silver today becomes more expensive than the price of silver in the future? It means the informed minority is no longer willing to wait for a promise. If this backwardation signal confirms, it won't just be about a price move, it will be about the total collapse of the delivery system itself. To understand why the world's largest banks are terrified of this March meat grinder, we have to look at the secret code written into the March to May spread. In a normal market, futures further out in time trade at a premium to the current spot price. This is called contango, reflecting the costs of financing and storage. But right now, we are watching the March to May spread very carefully. If nearby silver begins trading at a premium to future silver, the market has flipped into backwardation. Backwardation in a physical commodity market sends one message and one message only. I don't care what the paper price says. I need the physical atoms now. It is the ultimate sign of a supply panic. As Jim Rickards described in Currency Wars, this is the point where financial warfare becomes visible. The paper construct that normally manages our perception of price starts to crack under the weight of real-world demand. We are currently seeing this gap play out in real time between Shanghai at $96 and the COMEX at $86. But if you zoom out, you'll see that silver isn't the only front in this war. Crude oil just moved to $67, its highest level since August. Bullish bets on oil are surging, and the big question in the commodity pits is whether this positioning is happening ahead of a potential escalation with Iran. This is a structural problem with a 20-year lag. Global oil discoveries have dropped 40% over the past decade. Between 2015 and 2020, we averaged 10 billion barrels per year. Between 2021 and 2025, that number plummeted to just 6 billion. When oil moves on both geopolitical risk and structural supply concerns, it adds a massive inflationary input into the same macro environment that is driving gold and silver higher. This brings us to our next open loop. India just confirmed another record month for gold imports. This isn't an isolated data point. It ings a pattern of Eastern physical demand that has been running at historically elevated levels for months. While Western media calls gold's rise to $5,130 a bubble, Asian sovereign buyers are making a deliberate judgment about where real value resides. Why are the world's most powerful central banks in the East abandoning the dollar for $5,000 gold and $100 silver? The mainstream doesn't have a framework for this, but the data out of the World Gold Council tells a very different story. One, that reveals a fatal flaw in how the West calculates value versus price. Mainstream analysts call gold at $5,130 a bubble. They use terms like speculative excess because they don't have a framework to explain why capital is fleeing the dollar at this pace. But if you verify the Indian import numbers or the Chinese ETF flow data, you see a very different reality. This isn't retail noise. This is a deliberate, quiet judgment made by institutions and sovereign buyers in Asia. They aren't betting on gold. They are exiting a system that no longer offers them a fair return or security. When the World Gold Council reports historic central bank buying, they aren't talking about momentum trading. They are talking about the final stage of a multi-decade structural shift. But here's the open loop that separates the analysts from the promotion. The Shanghai session today showed something very instructive. Silver opened at 99, hit 102, but it closed at 96. It did not hold the $100 level. Price discovery was volatile, and it ultimately settled lower than the open. This tells you that there is real selling pressure at these levels. It's not just manipulation. There are genuine participants willing to take profits or reduce their exposure above the $100 mark. This volatility cuts both ways. The same explosive potential that points to the upside can produce equally violent downside moves if a coordinated intervention or a margin call cascade forces selling across all asset classes simultaneously. Western spot sitting at 86, while Shanghai is at 96, doesn't automatically mean Western prices must go up. It could mean Shanghai comes back down if physical demand signals don't sustain. How do you tell the difference between a temporary profit-taking dip and a systemic collapse of the paper price? The answer is in the tape. As Humphrey Neal wrote, the tape tells you what is happening, not when it finishes happening. We have to look at the physical premium versus the paper volume to find the truth. But there's a hidden danger in the Western volume data, a hollow signal that suggests the COMEX might be ghosting its own market. Why is volume flat while the premium is at record highs? We are about to uncover the arbitrage black hole in the next part. The data is telling us a story of two completely different worlds. On one side, we have Shanghai closing at $96 with a persistent $10 premium. On the other, we have COMEX volume that has essentially stalled. In a functioning global market, a $10 premium should trigger an immediate arbitrage. Traders should be buying in the West and selling in the East to pocket the risk-free difference. But for arbitrage to work, you must be able to move the physical atoms. The fact that this $10 gap hasn't been closed tells us that the physical bridge is broken. Either the logistics of moving metal are becoming too dangerous, or, more likely, there is simply no metal in the Western vaults available to be sent. The arbitrage is dead, and when arbitrage dies, the global price system fractures. We are no longer looking at one global price for silver. We are looking at a shadow price in the East and a suppression price in the West. But here is the open loop that the informed minority is watching with absolute focus. No new metal is entering the COMEX vaults. The registered category, the silver actually available for sale, continues to drain toward 88 million ounces, while the eligible category remains flat. If no new metal is flowing in, how can the shorts cover their positions for the March delivery? There are 188 million ounces of paper silver heading into settlement in just 3 trading days, with only 88 million ounces of available physical. That is a 100 million ounce gap. This is the arbitrage black hole. If even a fraction of those paper holders demand their physical silver, the COMEX officially hits a force majeure event. We are approaching the final seconds of the countdown. One side has to give. Will the shorts find a way to crash the Shanghai market before the Friday deadline, or will the Eastern signal force a total reset of the Western financial system? In our final part, we reveal the nuclear pivot and the only way to position yourself before the paper wall collapses entirely. We have reached the event horizon. As of today, February 24th, 2026, the silver market has fundamentally split into two irreconcilable realities. On one side, the paper price is vibrating near $89. On the other, the physical supply is vanishing into a black hole. We have documented the COMEX registered inventory crashing to 88 million ounces, a level not seen in a decade, while the open interest for March delivery stands at a staggering 188 million ounces. This is a 2-to-1 deficit that no amount of warehouse reshuffling can fix. The point of no return was crossed when China officially nationalized its silver supply. By implementing mandatory export licensing, Beijing has effectively removed 70% of the world's refined silver from the global market. They are no longer selling their silver for paper dollars. They are hoarding it for AI infrastructure and solar grids. This isn't just a trade move. It is a declaration of resource sovereignty. When the Shanghai market reopens tonight, we will see the Eastern signal, a physical price that could sit $10 above the West, proving that the COMEX has lost its ability to discover the true value of silver. So, how do you protect your wealth before the physical music stops? The strategy for 2026 is clear: decouple or be liquidated. Retail investors are being lured into paper ETFs, but the smart money is moving into sovereign vaulting. You must ensure your silver is not a contract or a promise. It must be a physical asset that cannot be cash settled during an exchange emergency. If you are holding paper when the COMEX activates its nuclear option, you will be handed a check for a price that no longer exists in the real world. The industrial giants like Tesla and Samsung are already bypassing the exchanges to secure their atoms. The billionaires are trapped in their shorts, and the vaults are screaming empty. We are about to witness the ultimate price decoupling, where the digital screen goes dark and the physical metal becomes priceless. Verify your holdings, read the data, and stay disciplined. The end of the paper era is here.